Welcome back, everyone. Today on the Joseph Carlson Show, we have a new survey showing that investors are becoming increasingly nervous about buying into the stock market. We know that the S&P 500 is up roughly 15% year to date. This is one of the best starts of a year ever. It's really a great start to the year. But now people are becoming concerned, and this survey from Bloomberg's Market Live Pulse survey says that the S&P 500 index has likely logged most of its gains that we'll see this year as investors are growing increasingly nervous about the stock market's rich valuations. They also believe that other things like gold will do better than stocks. We'll be discussing the survey in this episode. Now, we also have some other news to get to. There is breaking news recently that a Las Vegas jury has convicted 5 individuals in their roles of running a large unauthorized streaming service. Apparently, this made millions of dollars. It had more shows on it than Netflix, Amazon Prime, Hulu combined. And they ran this thing under the guise. In fact, it was called Jetflix. That was the name of it. That was the name of their streaming service. And they tried to disguise it as a aviation streaming service. We'll be looking at this incredible story of these 5 entrepreneurs and why they're facing jail time now because of their illegal streaming service. We also have news that Apple's being hit by further regulatory charges in the EU. This is under the new European tech law. Europe just passed a new law and they're very excited to try it out. And they're trying it out with Apple. So we're going to be looking at what Apple's facing with regulations in Europe. And then finally, we've heard news of Amazon's new AI-powered Alexa. Everyone's moving into AI. Alexa's doing it as well. But Amazon may be charging an additional $10 per month to use the AI-powered Alexa. We'll be looking at the details of that as well. So as always, we have a lot to get to in this episode. Let's go ahead and jump in. Now, of course, we start off with the news that the market is now predicting, or rather investors are predicting, that there's not much more upside in today's market. We know that the S&P 500 is up 15%, and that's considered the benchmark for the overall market. 15% in the first 6 months of the year is an incredible performance. This year has been fantastic for investors. If I look at my portfolios, I remain fully invested. That means that I don't have a lot of cash sitting on the sidelines waiting for a dip. The cash I have sitting on the sidelines is used for savings, it's used for an emergency fund, it's used to pay taxes and different things. It's not sitting there waiting for a dip in the market. So I'm fully invested. I try to invest every single month in my portfolio. I try to find the best value companies. My portfolio right now is right at its all-time highs. $220,000 in gains, a value of $703,000. The majority of this year is not from contributions. It's not from new money added. It's from the portfolio going up because of capital gains. So some companies in my portfolio have done poorly, specifically Salesforce. This one has done the worst. I'm down $7,500 in Salesforce. But other companies in my portfolio have done incredibly well this year. Apple's now at $30,000 in the green. If we look at the 2 best performers in my portfolio, they come from an unusual place. Texas Roadhouse is in the green around $40,000 overall. It's up around $20,000 just this year, up 40%. Chipotle is likewise up 43% this year. It's in the green by $15,000. If we switch over to my other portfolio, the Story Fund, this one has gained around 25% value this year, and that's not counting contributions. If we look at this one, the performance has been led by Netflix and Amazon. Both of these have done incredibly well this year. So overall, we're having a great year in 2024. And even if we look at 2023, that was also a fantastic year. In 2023, the passive income portfolio gained 33%. The Story Fund, this one gained 65%. So both of them had incredible performance in 2023 as well. So for the past year and a half, this has been an incredible story and performance for the stock market and many leading companies. A lot of investors have enjoyed these gains, but investors now are starting to become a bit hesitant. The market has moved up so much, so fast, that investors are saying the party's over. A new survey from Bloomberg highlights that the majority of investors believe that most of the gains are done in the stock market this year. They say that the S&P 500 index has likely logged most of the gains that we'll see this year as investors grow increasingly nervous about the stock market's rich valuations. The 2024 rally, which has driven the US equity benchmark to 31 closing highs, so we've reached 31 record highs this year, has left asset classes more overpriced than US credit or gold. The majority of 586 respondents have said. So when they ask people what's the most overpriced between the S&P 500, credit, or gold, most people said the S&P 500. So people are pointing to the stock market, saying that's overpriced. Credit, bonds, gold, those things are still doing well. Now they point out that these investors aren't ready to hit the sell button just yet, but they are becoming skittish. For example, around half of the survey takers believe there's going to be a 10% correction this year. So the market's going to take a dip at some point or another this year. Another 35% say that it's going to happen next year. So investors are now getting to a point where they're not so enthused. They believe the US market's expensive. They think that there's going to be a correction right around the corner, either the next 6 months or into next year. And this is overall the tone of the survey. One of cautiousness, skittishness, one of predicting that we're going to see very minimal gains from here on out. Now, the first thing I want to mention with this survey is I was surprised by how much I actually agreed with it. I find in a lot of cases, I'll look at surveys or I'll look at research and I'll think, this is crazy, right? Who thinks this type of stuff? With this survey, I find myself agreeing with most of the sentiment here. I think US stocks are expensive. When I look across my portfolio, it's hard to really justify all the valuations with every stock. PE ratios have expanded. Earnings yields have gone down. Free cash flow yields have gone down. Things across the board are expensive. One of the videos I made a couple years ago, this was almost towards the very bottom, was one called Big Tech is Cheap. In the video, I went over all of the big tech companies and why I thought each of them individually was cheap. At the time that video was published, Amazon was $84 per share. Apple was $127. Microsoft was $227. Google was $87 and Meta was $127. All of these companies are roughly double to 4 times the price they were just a year and a half ago. So things have changed. Not only have these companies grown their earnings, but their valuations have also increased. PE ratios have expanded. Free cash flow yields have gone down. I would never make a video today that big tech is cheap. In fact, the most recent videos I've made regarding big tech's valuations is that they're not cheap. In fact, they're approaching a price that I consider kind of expensive. So this was a survey that I actually agreed with a lot of the sentiment here. And I also believe that their prediction of a market correction over the next 6 months, the market going down 10% or even into 2025, is also not unreasonable. In fact, I think it's likely. There is a good chance over the next year and a half we're going to see a market correction. I agree with that. I think it's very likely. The problem with these type of surveys is you have proper sentiment here. You have a lot of people aware that there's likely going to be trouble ahead. And the big question is, what do we do in this situation? How do you act on this information? Because even though I agree with almost everything being said here, I may have a completely different approach of how to handle this. One of the most instructive articles on this subject comes from Peter Lynch. From the archives, all the way back in 1992, Peter Lynch published his words of advice about upcoming market corrections or crashes. He says that the Dow has passed 4,700, which has brought new worries about a nasty correction. The worrying started as soon as we recovered from the last nasty correction in 1990. There's no end to the list of probable causes for repeat. Too many mutual funds chasing too few stocks. Stocks are overpriced. The dividend yield on the Dow is at an all-time low. And this one is my favorite. Not enough investors are worried. Now, again, this is in 1992 is when Peter Lynch published this. And it's incredible how similar all these concerns are to today. The concerns really never change. Too many mutual funds are chasing too few stocks. Now, the mutual funds is a little dated. I'll give you that. We've moved on from mutual funds to ETFs and just hedge funds. But have you not heard the same thing said repeatedly? There's too much money chasing too few stocks. That's something that I've heard over and over again. That's something that Howard Marks, a notable, very conservative, almost bearish person, has said repeatedly. Stocks are overpriced. We hear that all the time. That's what this survey is saying right now. The dividend yield on the Dow is at an all-time low. Earnings yields are at an all-time low. The free cash flow yields at an all-time low. All these different statements that we hear repeatedly, showing us that we should be concerned about the future in the stock market, are the same exact statements that Peter Lynch heard in 1992. But Peter Lynch clears this up. He says another big correction is on the way. I'd bet the ranch on it. If I had a ranch, it may come this year, next year, or the year that the Red Sox wins the World Series. Don't hold your breath. But sooner or later, it will happen. You read it here first. People predict market declines all the time, and they're usually correct because the market will eventually decline, especially a 10% decline. That's not even that big of a decline in the grand scheme of things. But we make these predictions, and in many cases, the worst thing people can do is base their investments off of these predictions. The skittish investor begins to dabble in futures and options, the kind of investment that will make a profit when stocks decline. People think of this as correction insurance. It seems cheap at first, but the options expire every couple of months, and if stocks don't go down on schedule, people have to buy more options and renew their policy. Suddenly, investing isn't so simple. Investors can't decide whether they're rooting for stocks to falter so their insurance pays off, or for the rally for the sake of their portfolio. So hedging your portfolio isn't as simple as buying insurance. And even in the case of buying insurance usually isn't a good idea if you can afford not to. The only reason that people buy insurance for the most part is they can't afford not to. For the sake of your portfolio, you don't need insurance if you have a long-term mindset. If you're invested for the next 5 to 10 years, you do not need insurance on a portfolio. The second form of market timing that people do is the ritual known as lightening up. The investors sell some or all of their stock in stock mutual funds, or they put off buying stocks in companies they like and sit in cash, waiting for a crash. Better safe than sorry, they say to themselves. I'll wait for the day of reckoning when all the suckers who didn't see it coming are wailing and gnashing their teeth. I'll snap up bargains left and right. But once the market reaches the bottom, the crash sitters are likely to continue to sit in their cash, waiting for further declines that never come, and they miss the rebound. Lightening up is a form of market timing. Now, you may not be fully committed, you may not be 100% in cash, but if you're selling stocks left and right and building a cash pile, waiting for a sell-off, you are trying to market time. And the evidence and data is overwhelmingly against you. You can't build up a huge cash balance and hope for a market sell-off. It requires you to do two things that are incredibly difficult. Time when to sell, hoping that the market doesn't race up even further, and then the more difficult thing, timing when to get back in. Do you get back in when the market goes down 5% or 10% or 20%? You don't know. You can't see the future. So when you're lightening up, selling out of some positions here and there, you are market timing. Don't try to trick yourself into thinking it's something different. So again, when I look at surveys like this, and I see that most investors believe that the market gains are mostly behind us, they think things are expensive, they look at PE ratios and valuations, and they get a little bit hesitant or skittish. I agree, I have all the same sentiment, but I continue to buy the market even at all-time highs every single month. I try to pick companies that I think are the best value as possible, but I am still deploying cash every single month, just like I did all throughout 2023. One of the people I believe has the best advice today on this subject is Tom Lee. He's someone who has been far more right on this market than wrong. And here's his advice on buying during a market high.
You know, I know investors generally aren't comfortable buying things at a high, but if we're mid-cycle, which we probably are, then we're going to be making a lot of new highs over the next 5 years anyways. And I think there's a lot of statistical support showing buying at new highs actually has a better win ratio than attempting to buy at lows.
It's just spot on. It's very likely that there's going to be numerous more all-time highs over the next 5 years. Most data supports that, and the data also supports his claim that it's much better statistically to buy at all-time highs than to try to buy at lows. Trying to buy at lows has a much worse win rate by investors. So I believe his advice here is both accurate and cogent. Now, changing gears a bit, in this channel, we've covered a lot of cases of business fraud. I personally find these situations fascinating. These stories are really incredible. Like the story of Nikola and Trevor Milton. He wanted to start an EV company. It was actually with hydrogen, and they were going the semi route. Nikola is still a stock today. They're still diluting shareholders, doing reverse share splits, and just taking investors' money and lighting it on fire. But regardless of all that, you had the story of fraud. Nikola wasn't just a bad company. It was a bad company that lied to investors. They came out with a promotional video showing a truck seemingly driving itself. It looked as though it was propelling itself with its own engine. In reality, what they did was they brought the truck to a top of a hill and rolled it down the hill. They filmed it in a style where it looked like it was propelling itself. That's fraud. That's lying to investors. Nikola did this along with a lot of other examples of deceiving investors, leading to Trevor Milton being arrested. You also had the case of Theranos with Elizabeth Holmes, of course, starting the blood testing firm. She continually promoted different things that were untrue over and over again. She misrepresented the technology and the state of it to investors repeatedly. It led to her being arrested and charged for fraud. And this all leads into this next news story. Another case has emerged where this time it's 5 men. 5 men have started a streaming service. Now, when you think about 5 guys starting a streaming service, you may think about, them getting funding, them starting to film their own content. them distributing it themselves. You could think of cases where other streaming services are emerging. You have the Roku one, the Roku Originals. There's situations like that. But unfortunately for these 5 men, they decided to go an easier route. They decided to just scrape different content off the internet, specifically from the major streaming services like Netflix and Amazon Prime, and they just put it on their own streaming service and sold a subscription to it. That's the business model. The business they started was to literally just record different shows, put it on a website, and charge a subscription to other people's shows. That's the basics of it. And not shockingly, when you take a lot of good content and you put it on a cheap service, you get success. A federal jury in Las Vegas convicted 5 men this week in their roles of running one of the largest unauthorized streaming services in the United States, which generated millions of dollars in subscription revenue while causing substantial harm to television programs and copyright owners. The concept seems so simple, but the fascinating part about this story is that they ran into normal business challenges running this illicit streaming company. For a $10 monthly subscription fee, the users could watch shows on multiple devices and platforms within days of the new episodes appearing on legitimate services and channels. The defendants ran a platform that automated the theft of the TV shows and distributed the stolen content to the subscribers. So this wasn't any small-time operation. They were stealing so much content from legitimate sources that they had to write software to automate the theft, to do the scraping for them because it was too difficult to do manually. And they scaled this operation up. Jetflix claimed to have more than 37,000 paid subscribers. 37,000 monthly subscribers at one point. Like a legitimate business, Jetflix eventually ran into problems, such as subscribers sharing logins and passwords. This is just the best part of this whole story. Jetflix is an entire company that's based off of ripping off other people's content. They've automated stealing thousands of episodes from different streaming services. They put them on their website, and then they're selling subscriptions, getting rich doing so, to 37,000 paid users. But then they ran into the trouble of their users not respecting their passwords, and they're sharing their passwords with everyone they can, and they're ripping off Jetflix. It's just hilarious to think about a business where your entire business is based off of ripping off other content. You're just copying other people's content, but you're upset that your customers are sharing passwords. Oh, they can't do that. That's unfair to us. They can't share passwords with their buddies. They're getting our stolen content for free. We should never allow that. They must be so concerned that people are stealing their stolen content. Officials also said the group tried to disguise the site as an entertainment service for aircraft flyers after it faced inbound demands to remove unlicensed content. These have got to be the dumbest fraudsters that I've seen so far. Now, I think what Elizabeth Holmes did was kind of dumb and also kind of smart. She was like kind of on the edge of it. I thought what Trevor Milton did was really dumb. Faking demonstrations, that was pretty dumb. But these guys win. They're at the top of the list. They are by far the dumbest fraudsters that I've covered so far. Their big idea of how to hide this giant entertainment streaming fraud was to pretend it was a service for aircraft flyers. That was it. That was what they could think of. That was their best idea of how to hide this. Imagine the scenario of the copyright holder seeing their content on their website, very clearly that you can get to for $10 a month. It's illegal. And them saying, take it down, it's not your content. And then Jetflix responds, well, we're not really a streaming service. We're just a streaming service for aircraft flyers. Ha, that's our defense. And then the copyright holder saying, I can clearly see our content on your website. What was the plan here? How do you hide that you're running a massive multi-million-dollar streaming service with 37,000 subscribers? Calling it Jetflix and pretending it's for aircraft flyers is their best idea. It's just amazing to see people come up with these ideas. Now, I know this is surprising, but disguising the company as an aviation entertainment company shockingly did not work. And much like the legitimate business world, about 7 years after Jetflix started, one of the members of the group broke away to launch a new competing endeavor. This is like the story of every founding of every great company. There's usually the group that founded it, and there's one individual that takes the idea because they're not being treated fairly or they didn't get enough equity or something, and they go start a competing service. But they did this in this fraudulent, dumb idea of ripping off streaming services content. This is so similar of what you see with legitimate companies. You see that all the time, and in this case, we see it with Jetflix. Daryl Julius Polo, otherwise known as DJ Pimp. That's what it says here. He launched I Stream It All, which allows users to stream downloaded TV shows and movies, the indictment states. So he was the one that broke off. DJ Pimp thought, I'm not being treated fairly by the other five guys, right? They're not doing what I want. I have a different vision. So I'm going to launch my competing service, I Stream It All. And it's basically the exact same service with a different name, but at a price point that's not quite as attractive. His subscription plan was a monthly fee of $19.99 plus quarterly, semi-annually, and yearly options. What's even the purpose of this? You know, $20 a month, $30 a month. You're getting to the price point where isn't it just easier to sign up for legitimate services? Netflix is $7 per month. For their ad tier version, it's $7 a month. You're paying extra to visit these illicit websites where the owners of them are being tracked and thrown in jail. There seems to be even inflation and cost to run these services, even for the illicit ones. Jetflix also had its own org structure. Dahlman ran operations, while Carlson assisted with management involving strategic decisions and hiring and dealing with vendors and payment processors. Programming and coding was handled by Dahlman Polo, who is a programmer who wrote a revised computer script for the website and mobile applications. The group also handled web design, customer interface, and technical assistance. So they had a whole team, an entire org with different responsibilities. When I read this, I just imagine that they probably could have created something legitimate, something that wasn't completely illegal. I mean, they had a programmer, they had people that would run operations. They know they could at least service a website that had over 30,000 customers. I have to believe, part of me believes there's an alternate reality where these same five guys just created something that was legitimate and it was a success. They made a lot of money legally and didn't have to worry about being tracked by the authorities. Whenever I read stories like this, there's always two things that come to mind. First of all, there's no amount of money, no amount of millions of dollars I could be given to go under the stress and anxiety of knowing that you're doing something so illegal that you're under the pressure of potentially getting caught by the police, getting caught by the feds. Eventually it could happen and you have to worry about that for the rest of your life. There's just no amount of money, billions of dollars, and I still wouldn't want to be in that situation of constantly worried about my footsteps and being caught. I don't know how criminals do it. It seems like the worst life possible. Even if you're successful and you make money, just knowing that stress all the time seems so miserable to me. I'd rather be poor and know that there's no one coming after me. That seems so much better. The other thing is, I just read these stories and it's so obvious to me they're going to get caught. How would you possibly run an illegal business founded in the United States that you're streaming all of the biggest shows in the world to 37,000 people and have any segment of your imagination that you're not eventually going to be caught? To me, this is a 100% chance. You're 100% going to be caught. You're stealing from all the richest people in the world and you're distributing content to tens of thousands of people. The idea that the feds eventually wouldn't catch up to that is just incredible to me. So I don't think it's worth it even if you got away with it, but in these situations, I never think they eventually get away with it. They're eventually going to be caught one way or another. So there you have it, another story of dumb criminals getting caught doing dumb things. Now moving on, we have the European Union that they're very excited about this. I can just tell from a distance that they were excited to try out their new laws. The EU passed a series of tech laws targeted specifically at US tech companies, and they finally get to use them. The charges announced Monday are the first to be issued under the EU's Digital Markets Act. So this is a new big sweeping anti-monopoly act that they passed, and it was abundantly clear as they were writing this, it was almost like they were writing it specifically for Apple and Amazon and Google. It actually applied to almost no company. In fact, I don't think any company in the EU. They say it took effect earlier this year and sets out a long list of rules aimed at boosting competition in digital advertising, online search, and app ecosystems. Apple could be fined as much as 10% of its worldwide revenue if EU regulators ultimately determine that the company broke the DMA's rules. Now, of course, this is a preposterous, astronomical amount of money. Being fined on your revenue is crazy. They're not finding them based on how much money Apple actually makes in profit, but they're finding them based on their revenue and not just in their own countries. It's worldwide. So they're finding Apple on 10% of their revenue if they don't comply with these laws. At that point, I think Apple would take more aggressive stances. I think they would refuse to pay it. They might even pull out some of their services from the EU altogether. They say the changes cement Apple as a tech company that EU regulators are so far targeting and most aggressively under the new law. Now, investors are just considering this another fine from the EU against an American tech company, just like they've done over the past 10 years. So none of this is shocking at all. None of it is surprising. The EU has made it their goal to be the regulators of the world, the ones that will regulate AI. Even their regulators are boasting about it on Twitter, that they are so regulatory in the EU. Of course, that has led to less EU startup companies, less prosperous stock market in the EU, and the US being a place where most investors go, most capital goes to start innovative companies. So this does have an adverse effect for the EU. It is having an impact. In fact, right now, one of the most immediate impacts is it looks like Europe may actually be withheld from getting some of the more exciting features like AI from future updates. At least they'll get them a lot slower. Apple says regulatory concerns might prevent rollout of AI features in Europe. Apple is concerned about rolling out any new features, doing anything different in Europe, because they're getting fined so extensively for everything they do in Europe. So the US is a place where everything gets rolled out. They're not as concerned. So I see this as kind of a catch-22. Not all regulation is bad, but overregulation does prevent different innovations. And this news of Apple saying, we're going to take things slower in Europe, I think makes perfect sense. That's part of the trade-off with the regulatory environment. As far as Apple's concerned, I think at this point, everyone has this baked into the cake. I think everyone knows that Europe's going to be slower, it's going to be more regulatory, there's going to be more fines coming from Europe, it's going to be a consistent tariff and tax on Apple. So right now I see this as priced into the stock. Now this next news story is one that's not going to make people happy. Let's go ahead and go through it anyway. Amazon's new AI-powered Alexa may cost up to $10 per month. So we knew that Amazon's working on AI assistants, just like Apple is with their Siri, just like everyone is, just like Google already has one. But Alexa's something that's also still rudimentary, similar to Siri. Alexa can answer basic questions and look up things. I think it actually works decent, but it's certainly no LLM. It doesn't feel like you're talking to ChatGPT or Gemini. It's way behind that. And we know that Amazon has all the technology. They have all the server power. They can certainly build an LLM and combine it with Alexa. This was something that was talked about in demonstrations. Andy Jassy has talked about it. Even Jeff Bezos talked about it on the Lex Fridman podcast, that Alexa is going to get a lot smarter. But most people assumed that this would be included with Prime, or it would be included for free. But it seems like it may not be completely free, at least the most advanced part of it. Amazon's former senior vice president of devices and services hinted at charging for a more capable version of Alexa. And now we have an idea of how much it might cost. A report from Reuters suggested that Amazon's AI supercharged version of Alexa could cost anywhere from $5 to $10 per month on top of your Prime membership. So an additional membership monthly subscription on top of Prime. Sources tell Reuters that Amazon is aiming to launch the new Alexa in August, making a desperate attempt to overhaul the voice assistant. The paid version of Alexa might not require users to keep saying Alexa when talking to the assistant. It will also reportedly be capable of completing multiple requests in one prompt, such as writing a short email and ordering takeout on Uber Eats. This is one of the issues I have with Alexa in general, or any voice assistant, is a lot of the examples they give of how to use it are things that I would never do in the first place, like ordering Uber Eats or DoorDash from Alexa or Siri. That's just not something I'll ever do. When I order food from DoorDash, which I do infrequently to begin with, but even when I do, I want to see my order in front of me to ensure that I have everything correctly. Having a voice assistant order you food does not seem like the best application. If you order from a voice assistant and you say all of these things you want, all these different sides you want, and you have the assistant say, okay, I put in the order, how do you really know it's correct? You'd have to have the voice assistant read back the order, which would take more time. It just does not seem like the best use for it. It seems like they're making up a lot of situations where you would use this when you really wouldn't. And ordering food is certainly an application where I want a screen. I want something visually in front of me, which the phone provides. Now, they also mentioned this doesn't mean that Amazon will leave out the free version of Alexa. As noted by Reuters, Amazon will still plan on replacing the basic version with one that offers new generative AI features, but it will put more of an advanced Alexa behind the paywall. So they're doing the freemium model here, similar to what they did with music. Amazon had a free version of their music app, was included with their Amazon Prime, and then they have one that you can upgrade to for a bit more per month. It's also similar to what they're doing now with Amazon Prime Video. You have the version of it that's included with Prime, where you have a couple of ads, or you can pay $3 more per month to have the no ad version. They're doing the same thing with AI. So I realize this is going to make a lot of people upset. Most people want the best version of the AI included in their Prime membership. But it seems like Amazon is still following the same course they have before, charging a little bit extra for music, a little bit extra for video to have advanced versions of it. And it will be interesting to see how customers receive this. That's all for this episode of the Joseph Carlson Show. If you want to see more content, you can do so by joining the Patreon. It also includes a full membership to Qualtrim.com. Other than that, see you in the next one.